We've got Rajat Monga, who's Group President for Financial Markets. He's also Chief Financial Officer at Yes Bank. He joins us on the show right here in Mumbai. Now, Rajat, to begin with, following the RBI's CRR cut that we had a few days back, how much of a relief have you seen, that's Yes Bank seen, in terms of liquidity?
Yeah, liquidity on the relative scale has become easier, though I'm maybe speaking a little early because at the right moment this time the liquidity continues to be as tight as it was before the CRR cut. In fact, the CRR cut, in our judgment, has only replenished the liquidity we have lost to RBI on account of their recent intervention in the dollar rupee market. So we believe that the Reserve Bank of India may have intervened a little in excess of $15 billion, and that corresponds to about 75,000 crores of rupee liquidity that banking sector has lost to RBI, and the CRR has compensated about 80 odd thousand. So it's actually a neutral development over a short period in that sense. In fact, in the absence of CRR cut, we might have possibly ended up in a very severe money market crunch environment. So I think it was quite necessary for RBI to having cut this, make this CRR cut, but it has only come to replenish the loss. It's not yet, so we would not qualify that as monetary easing yet. This is just a replenishment of the liquidity lost to the Reserve Bank's own balance sheet.
Sure, but Rajat, does the situation give you any room for cutting lending rates?
The Reserve Bank has to clearly cut rates before lending rates can be thought about in terms of being lowered. I think it's a little premature given the monetary stance of RBI being still at a hold, and therefore banks might be just jumping too early into that assumption. It might be a little bit premature. So we have to wait for the April policy for sure, though we still believe that there is a decent likelihood of a rate cut, token rate cut at least in the April policy, which might set the tone for banks to look at their lending rates. However, a necessary condition for lending rates to be lowered is also presence of satisfactory liquidity in the banking sector, which is something which I think we are still not very assured. Is because the liquidity still is tight despite the CRR cut. Today we have about 1.5 trillion rupees short in terms of the repo balances.
Sure, but Yes Bank offers the highest savings rate in the industry at this point of time. Given that the rate cycle has turned, how much longer could you persist with such a high rate?
I think the turn, yes, interest rates are likely to turn, but I think the pace is not going to be super fast in any case. I think we might be budgeting for a 75 to 100 basis points of rate cuts by RBI over the next 12 months or so. I think that keeps us well clear of the other hurdles in terms of pricing our savings account deposits. In any case, when we price our savings account deposits, we view savings accounts as medium-term balances. They tend to be sticky.
So Rajat, run us through what kind of pressure maintaining a high savings rate such as yours puts on your margins, and what's the outlook for your margins going into FY13?
We have about 13-14% CASA levels that we are operating from. Our visibility of CASA for, let's say, medium term that takes us to March 2015 is about 30% share of CASA. And along the way, we should be able to increase our margins to close to 3.5%. So we should see some incrementality every year, maybe even every quarter, as we improve our CASA percentages.
Now, Rajat, just focusing on the fixed income markets, we're seeing bond deals holding up at fairly high levels. Why would you say this is happening, and do you see them coming off anytime soon?
I think this is just the volatility which is associated with when the rates need to take a bend. I mean, we have been holding rates for a few months, and there is the next possibly move, as RBI is themselves admitting, is for lowering rates. So I think it's just a correction of that, I would say, sentiment which was carried into the monetary policy and the budget. I think the market was also expecting a notch lower funding program by the government in terms of monetization of its fiscal deficit. So yes, those factors have played into the bond yields moving up from 8.2% levels to about 8.4% levels. We don't believe that there is too much panic in that direction either.
And also, Rajat, what's your outlook on asset quality for the overall industry going forward?
So I think it's a reasonable assumption to make that given that we are towards the bottom of this slowdown, that the asset quality cycle will remain weak. As we play out the bottom over the next 6-9 months, I think we should be clearly past the bottom of this slowdown. Beyond which is when the environment will begin to improve. I think we need lower rates predominantly so that we can lower the cost burden of the borrowers. At the moment they are facing a slower demand and steep costs, so I think that's not the best position to be in.
And finally, Rajat, what are your fundraising plans and what expansion plans do you have for the next fiscal?
Well, we have, let's say we are working on tier 2 fundraising at this point in time. I think we have about, we are working on anywhere between a $200 to $250 million tier 2 plan, which we are executing in the current quarter across lower tier 2, upper tier 2 and hybrid tier 1 issuances. And that's well underway, so we should close this quarter with about $200 million fundraising on the front, which is debt capital.